Hello and welcome to this very special edition of Taking Stock, the Fear Factor. You guys know why we've called it the Fear Factor. That's because of the immense capitulation that we saw in the markets last week. The Nifty was not down as much, about 2.5% or so, but the mid caps were down 6% and the small caps were down 10% last week. So here we are at the Taj Lands End. We are attending the 6th India Investment Conference where more than 500 registrations have taken place, and we're going to speak to two very special gentlemen in a bit as well. Anuj is with me as well. Anuj, a week to forget?
Yeah, week to forget, Sonia, but truth be told, warning signs were there. For last 3 or 4 days we were pointing out that this is the market which is telling you that get out of mid caps and small caps. It's going to shut the exit doors. The market gave 3 or 4 exit opportunities all through the week, but on Friday that was taken out. On Friday you saw the small cap index go down 6%, and so many index stocks are at 52-week lows now. The index was already in a bear market, let's make no mistake about that, and now you are running the risk of correcting the excesses in the mid caps and small caps. But my sense is that what you saw in the mid caps and small caps this week was actually a healthy process, something we have seen in the past as well, that's going to make market healthy. But then, let's see. This is a bit of a falling knife kind of scenario, and global markets need to stabilize before we can say that the worst is truly over.
Oh yes, there was so much volatility in the global markets, but we have two gentlemen here who are joining us from this conference. We have Navneet Munot, the Chief Investment Officer of SBI Mutual Funds, and Jayesh Gandhi, the Senior Portfolio Manager at Birla Sun Life AMC. Gentlemen, thank you for joining us. Navneet, let me start off with you. When we entered here, you guys were telling us that no one wants to listen to us now with the markets have fallen so much, but you guys are the voices that everyone would want to listen to, because retail has invested so much money in this market. What would your advice be to retail investors now post the fall?
So just 18 months where people have invested, but before that we had 5 or 6 years of continuous redemptions in mutual funds. They also pulled out money from the unit linked plans. There were hardly any IPOs. There was very little money that has gone into equities. So the overall money that has come into the equity market over the last 18 months look big, but I think it's very small compared to the total household savings, and you have to see what's happening in the other asset classes. On a relative basis, I still think equities are one of the most attractive class to put money. People have very little allocation, and I think this kind of market is giving a good opportunity to enter from a longer term perspective. I just heard Anuj saying we are in a bear market. This is, I think, a bull market correction. I don't think that we can call it a bear market. This is not going to sustain for a long time, that markets will keep falling and we'll have several stocks touching 52-week low on a daily basis. And this is unlikely to sustain the way it has been today, or let's say the last week. Dark clouds are always followed by a shining sun. This time won't be any different.
Or this time it won't be any different. Have you seen any kind of anecdotal evidence of panic in the retail side in terms of some calls, should I withdraw, should I stop my SIPs, or are you seeing a different kind of retail this time which actually wants to take advantage of this fall and wants to buy and actually increase the allocation to equities?
I think in last couple of months, couple of quarters, actually it has changed. When market falls, typically we get more subscriptions on that day. I think investors are maturing. They are taking a longer term call. Equities on a tax adjusted basis over a longer period likely to deliver far better returns than most of the other asset classes, and I think people are taking that, and there is a long term orientation in the money that is coming. We also hear SIP periods which used to be 1 year, 2 year, 3 year. People are talking about 10, 15, 20 year SIPs, which wasn't the case till some time back.
Okay. Jayesh, what's the mood like? Are people worried about getting into a global recession worldwide, or is this just a passing phase?
No, I would believe that people are supportive of the market. People believe that equity markets in particular will give good returns over the long run, and there is a fair bit of understanding that this is a corrective phase. A couple of great themes and that we heard today. One of the big ones was that the best returns is made when there is blood on the street. Wouldn't you call the last few weeks that kind of a situation? So any long-term investors would be looking at opportunities rather than being worried about what's happening in the market today. Talking about corrections and talking about mid caps in particular, our sense is that mid caps had not seen this kind of correction for fair amount of time, although the large cap market was correcting. So in a way, all segments of the market have to show corrections for a healthy correction for the entire market to happen. And I think we have got into the second phase of the correction, where the mid caps are also correcting. And I think from a medium term to long term point of view, this is very, very healthy. And what we are sensing from the investors are that investors are welcoming this. They would probably want to use this as an opportunity to invest more from a medium to long term point of view.
Okay, Jayesh, the clear trigger for this market fall was China. We saw the way yuan moved, there was some Chinese data, and all of a sudden all markets were scared, and there was this fear factor that we're talking about, and we saw the impact on the US markets as well. At some point we'll decouple, but for now, for how long do you think we'll have to endure this pain of these global cues?
Well, global cues are something that have made the market, especially in India, Indian equities fairly nervous in the last 2 months. And generally these phases don't last beyond a quarter or so. So I guess I would like to believe that we are at the tail end of the global uncertain environment. Let me correct you a bit. My sense is that more than the Chinese currency, it was the correction in the US equity markets which saw bigger corrections in other emerging markets, and India was no exception this time. And the reason probably is that US economy is probably one of the fastest growing in the world, and if that economy started, and that was one of the top performing equity markets last year, and that has started seeing correction, then probably it's kind of a contingent spreading across the world. But remember, the top market will always correct at the end. And so I again would like to believe that we are probably at the tail end of this correction. We may probably stagnate or consolidate for some period of time, but I would like to believe what Navneet said, that we are probably in a bull market with some short-term correction.
Okay. What about the large caps? I mean, good quality names are correcting like it's nobody's business. I mean, ICICI Bank, Axis Bank, TCS, Dr. Reddy's, all sitting at fresh lows. I take your point about some issues in the banking sector, etc. But is this a good time to be going out and buying into some of these large caps that are sitting at lows, or do you think that one can get better levels in, say, the next 3 to 6 months?
It's always very difficult to catch the bottom. I think if you like a stock, if you believe fundamentally it is good, it's falling for some other reason. I mean, there are two things. One is, for some of the names, there could be genuine issues that in terms of the balance sheet or in terms of the near-term profitability.
But that's the problem,
But if you
right?
genuinely believe some good name and you take a structural long-term call, I get reminded by this quote by Howard Marks: when the knife stops falling, when there is absolute clarity on the horizon, when the dust settles, you can be rest assured there won't be any bargain left. So I think there is discomfort today because you're worried about China, you're worried about what the US Fed is going to do, you're worried about the geopolitical risk, you're worried about that again this the asset quality issues with the banks. That's why you're getting these valuations in some of these names. But if you believe that franchise is strong over a longer period, things will get sorted out, the government is doing the right things, the economy has got potential, I think India will do well. Some of these companies will do well over a longer period. But
how do you find value? Because, okay, banks have asset quality issues, IT has slowdown issues, pharma has US FDA issues. So where do you really find value?
So, instead of looking at some of these stocks, probably put money in my fund, and I think we will. So over the last year, on a very serious note, so over the last 1 year, where the market was down, where the index was down, I think several of the funds could deliver decent return. So when you look at the profit growth of the Sensex or Nifty or let's say BSE 100 and the profit growth of some of the fund portfolios, I think that will be substantially higher, because you just need to ensure that some of the companies which are dragging down the profitability are not in your portfolio. And I think this year, when you have this kind of indiscriminate selling because of variety of factors, there are some redemptions from the EM funds and also here maybe the retail selling that Anuj rightly talked about, I think then you get some of these bargains which you can buy and then wait for a couple of quarters, couple of months, years to make money.
What if this is actually worse than 2008? For all you know, 2008 has become a benchmark, and a lot of people come and say that this is not as bad as 2008. I ask, what if it is worse than 2008?
No, so we could very well have a situation where for an extended longer period of time we would go through this consolidation phase. But at the end of the day, companies are on their own are doing things to change the trajectory of their own earnings, and that will ultimately start reflecting in stock prices. So I guess there were 2 or 3 key issues, but the fundamental issues with the equity markets probably in the last 12 months has been that the earnings growth has been very, very poor. Our sense is that next 12 months you will see a big change in that trajectory, both for the large cap indices as well as the mid cap indices, and you will see substantial improvement. And once that factors in, you will have the real fundamentals come into play. Some of these technical issues and short-term issues will get disappear. So earnings growth is what investors should focus on. That is the fundamental reason why stock price should be what it is.
And ignore the global news for the time.
And ignore, at least for the short term, ignore it. Because most of this may not really affect India in negative way.
Well, as you heard, that's an optimistic lot that we're talking to, but we're not done with the questions just yet. Stay tuned, we'll come back in a bit.
The last 7-8 years, 8 years to be precise, from Jan 2008 till date, the index is up only 20%, the large cap index, and the nominal GDP would have grown more than 120% over this period. So I think definitely the market cap to GDP of India is in a very attractive zone, and therefore I think the outlook for the markets over next few years, to my mind, is very positive.
The fact that a number of large cap sectors have become uninvestable, but large investors in US, and when they come in, they want to own names for 4 or 5 years, and in fact these guys, I'll tell you, they are much more, they are very happy to look at names, even smaller names, where management quality is good, earning visibility is higher, and the capital efficiencies are good.
I think the structural flow story from domestic institutions is still in place in India. This is a story about less competition from fixed deposit rates, and over a medium-term view, you've had a reasonable compounded return from Indian equities. What you've always got to remember with flow stories is, as a fund manager, if I'm nervous, I can choose not to invest that money that's coming in and wait for a better price. I think you could retest those lows if this uncomfortable story in China was to play out.
The guys who are not there in SIP, if there is one time to start, it is now. Because in down market only you must start, and in down market you must not stop. Very purpose you did the SIP in the good market. Looking back, I'm saying at 9,000 you started SIP. You did that because you are not comfortable with 9,000. You thought that market might come down to 7,000. But now when market has come down to 7,000, you should not stop it. On 1 year basis, I'll be very surprised your market is 10% down from here. Very unlikely. See, it's all probabilistic. In the market, it's all about the probability. If you ask me, I will give 70% probability, 75% probability that market will be higher from here, a year henceforth. But there is a 20-25% probability that market could be 5 to 10% lower.
We are very differently positioned today than we were in 2008. In 2008, all markets were at all-time highs pretty much. If you use market cap to GDP ratio as an indicator of overvaluation, most markets were in the 140-150% range of market cap to GDP in 2007-8. But over the last 7-8 years, there's been massive divergence. I think the sort of effects that some sort of global correction would differ from market to market. I don't think it's the same degree of negativity across the board as we saw in 2008 that all markets will experience.
Welcome back. Well, we're watching Taking Stock, the Fear Factor, and me and Sonia are here at Taj Lands and taking stock of what's been a brutal week for stock markets. Our guests are Navneet Munot and also Jayesh Gandhi. So let's carry forward that discussion. What if we see, because of China or because of US markets, any kind of major accident? We've seen, for example, Brent crude now below $30. NYMEX also is below $30. What if we see some of the sovereign funds defaulting, or seeing big redemption pressure? Is that a risk which the market has fully factored in?
Which is already happening. The world has to realize that an oil at $100 and oil at $30, a large part of the wealth is actually shifting from the oil producers to the oil consumers. Now think from a macro perspective, is it good for or bad for India? We're getting worried that some outflows can come from sovereign wealth fund. But just think of it, how much money this country was sending overseas, which will get invested here. This will be in my wallet. I may use it for consumption, I may start saving a little more, which will get invested in the country. Is it a good news? Is it a bad news? If the world is less growth potential, the another thing you have to think that this time the commodity fall is more driven by a higher supply. This is not a completely demand destruction, because so much of steel capacity has come up, because so much of new oil, shale, alternative energy is playing a role, which is a good thing.
But that
the
also
world goes
puts,
through
that
some
also
of
puts
those.
earnings recovery at risk, Navneet, right? I mean, is that not a risk then?
As I said that last year, why some of our portfolios could deliver better returns, because you need to be conscious about where it's going to add to the earnings and where it is going to, the earnings are going to get depressed.
It's the kind of exposure that these metal companies have to banks, right? Wouldn't you worry about that? I mean, the kind of increase in NPAs.
That's a worry. Isn't it getting reflected in the valuations?
But who is to say that these banks don't fall more?
Yes, one can always argue how much of that is already in the price, and then you adjust it for the franchise value, and the market sometimes forget the longevity of some of these businesses. On the metals, I think there were some actions expected from the government to stabilize situation in some of the particularly steel. Maybe at some point in time it is likely to happen. Some of the other governments in the world are doing to protect their domestic industry. Maybe our government will have to do a little more, and I think that then things should be okay. But that's a worry. So there are worries on the global account. On India account, one of the larger the balance sheets going into stress, creating a systemic risk for the time being is definitely a risk, and I think that's reflected in the panic that we are seeing in the market.
Yeah. Where do you think this market is going to find leadership to go back towards those previous levels of 9,000 or so?
Well, difficult for me to answer the question stock specifically, but if you see the earnings chart of say FY 2016 or even FY 2015, it's totally skewed. You have a set of companies which are showing earnings in 20% plus range, and you have another set of companies in sectors which are showing earnings in the minus 20% range. This large variation, large differential in earnings outlook needs to narrow. And that is where when you will start seeing earnings growth coming back, well, the hit that the indices are taking because of lower earnings in commodities and some of the other sectors needs to subside. And obviously we have other sectors like consumers, etc., discretionary, etc., or pharma or IT or whatever those other sectors are, those showing us good growth. And that is what I think will happen we'll start seeing in 2016-17. The reason why we've not seen in last 2 years has been because of the big collapse in commodities. When the oil went from 100 to 60, we thought that is it. From 60 it's gone to so it's halved again. So from 100 it went to 50, it's half, and then again it's halved again. Now, you could always argue that, look, from 30 can it go to 15? Yes, it can. I mean, nobody can really dispute that. But if that doesn't happen, and if we have broad commodity stabilization at this levels, okay, then our sense is that next year would be when you will see more normalization of earnings, and when that happens, you will see quite a few sectors which will take leadership. Oil and gas is a good example, because there the profits are coming back in a big way, very, very significant way. Would there be benefit for domestic companies consuming some of these metals and so like such as consumer discretionary, autos, etc. Then we have other economic factors which will boost demand because of you say a 7th pay commission and a whole lot of other government programs which are happening. So you have construction companies and those kind of sectors, infrastructure led sectors, which will really benefit. So you'll definitely find a lot of value in a lot of companies and sectors which will start demonstrating earnings growth.
Okay.
And that's what you should focus on. Yeah.
So that is one theme that both of you have spoken about, that this is perhaps the best bargain you've got in a very long time, so take advantage of it. Navneet, Jayesh did speak about some sectors. I'm going to slice through the sectors now. From the large caps, we've seen private banks, capital goods and telecom, two stocks each that have fallen to 52-week lows. All the index stocks, whether it's ICICI and Axis, DHEL and L&T, and Bharti and Idea. Now, between these three sectors, private banks, capital goods and telecom, where do you see the highest value?
Again, so if I can put in a different manner, that why we could do well last year was that if you avoided corporate balance sheets which have a lot of leverage, lenders who have a lot of exposure to these people, and commodities. Broadly, I think these 2 or 3, I think if you avoided, you could do well. Maybe at some point in time, valuations for some of these will also become attractive. So some of the names that you talked about didn't have the place in the portfolio last year, but maybe some of them are reaching levels where we need to seriously think about whether this is a good time to get in, and relative to some of the other
corporate balance sheet
stocks.
is ICICI Bank. So am I getting that
Corporate
right?
lenders. So the retail lenders have done phenomenally well, and including the NBFCs and some of the private sector banks have done exceedingly well. And while the corporate balance sheets, for the right reason, because there is a lot of stress is still in a part of the corporate balance sheet, and wherever you had that higher exposure, I think the stress is very visible. But I think at some point in time, most of it will get reflected into the price. Just go back and think about, and I keep thinking again and again, even my team, I keep them reminding about the October 2008 to March 2009, and just think and go back and watch that whole movie again, how it kind of started and how it ended, and where we were in July 2009. We shouldn't lose sight of that.
We shouldn't lose sight of that. We have just 30 to 40 seconds left in the show, so let me just take one last question from both of you, and I would appreciate a quick answer. Navneet, to begin with, do the markets go back to all-time highs in 2016, or is that a level that's going to be tough for the markets to achieve?
So I don't know whether in next 11 months or so, but I think probably 15 or 18 months. Again, I think the stock picking is far more important than the index level. There are lots of structural factors for that, but since we have 30 seconds, maybe we can discuss some other time.
Okay, Jayesh, okay, let me expand the time horizon, not just 2016, but middle of 2017. Do you see the market going back to all-time high?
I would like to believe that they could. And you'll be surprised how quickly the markets will recoup back. We've seen that in the past as well, like the time that Navneet mentioned about 2009. Very quickly some of these concerns will disappear, and we will start seeing markets flying. So investors should keep the hope and keep the patience. This business is all about keeping the discipline and keeping your faith in the stocks and the funds that you invest in.
Okay, so keep the hope and keep the patience, and the markets will bounce back. That's the view from the fund managers. But the market over the last 2 weeks or so has given a big scare, and a lot of investors would be sued by hearing what they've heard today.
Oh yes, and as they said, the biggest wealth is created when there's blood on the streets. So on that note, thank you gentlemen for joining us. With that, it's a wrap on this edition of Taking Stock. Thanks for watching.